Good morning, everyone. I'm Ms. Nidhi Burana, a faculty of Department of BCom Accounting and Finance. I'm so sorry for the discrepancy in between. Once again, good morning. I'm Ms. Nidhi Burana, a faculty of Department BCom Accounting and Finance. On behalf of Principal, CEO, and the management, welcome all the participants for the EMPORIO Summit, a RUSA-sponsored national webinar on investment avenues for millennials, organized by Department of BCom, Banking and Insurance, BCom, Accounting and Finance, and Bachelor of Management Studies. The millennial generation is getting older, and which means that the requirement for solving the complex finance and managing them is equally important. Forming good habits now can pay off over time. The webinar addresses investment in stock market and mutual fund and discussing mistakes to avoid in the stock market, also breaking certain myths regarding the same. I would now request the principal ma'am to say few words about our college, also Emporio Summit. Over to you, ma'am.
Yeah, thank you. On behalf of Chikitsik Samuha's Patkar-Varde College, I welcome you all to this RUSA-sponsored national webinar on investment avenues for millennials, stock and mutual funds. Patkar-Varde College is a premier institute in the western suburbs of Mumbai. Our college was re-accredited by NAC in the third cycle with a score of 3.53, and autonomy was conferred on the college from the academic year 2019-20. Am I audible? Am I audible?
Yes, ma'am, you are audible to us.
We at Patkar-Varde College are constantly upgrading our courses and infrastructure to provide students with the best possible learning opportunities. And in keeping in line with the vision of our institution to bring about holistic enrichment in the students, various departments organize webinars, conferences, and workshops. And today, the departments of BMS, BBR, and BAF have jointly organized this national webinar on investment avenues for millennials. I welcome the speaker for this webinar, Mr. Anupam Rupta, the SEBI research analyst and a certified financial planner from Jaipur, Rajasthan. Welcome you, sir. I thank the management of Patkar-Varde College, the president of Chikitsik Samuha, Shri Kishore Rangnekar, the vice president of Chikitsik Samuha, Dr. Kiran Mangaonkar, the secretary of Chikitsik Samuha, Dr. G.V. Pandit, and our CEO, Dr. Mala Karkar, for their constant support and encouragement always. I'm sure this webinar will definitely benefit all the participants and help us make better investments. Wishing you all great success for this webinar. Thank you.
Thank you so much, ma'am. I would now like to request Dr. Sheetal Patil, a faculty of Bachelor in Management Studies, to please introduce our speaker for today's Emporio Summit.
Thank you, Nidhi ma'am. Hello, good morning, everybody. I'm Dr. Sheetal Patil from BMS department. I would like to introduce our speaker for the day. A very warm welcome to you, sir, for today's Emporio Summit.
Thank you.
Sir Anupam Rungta is a SEBI registered research analyst and a certified financial planner. He has been helping people with investment strategies, stock market, and mutual funds for over 10 years now. Sir grew up seeing his father read annual reports, journals, and business newspapers. His father started investing in the stock market way back in the 1978. This is where Anupam sir's investment journey started. Subconsciously, he was learning about markets, investments, compounding, etc. from his father. The best decision of his life is that he started investing from his very first paycheck in 2006. Quite motivational, sir. Stock investments have made him financially free, and this is one of the major reasons he is in this field. He loves doing stocks and mutual fund analysis, and it makes him happy to share his learnings with the investor. So, with this quite inspiring background of sir, we would definitely this session will be more inspiring for student. So, without delay, I'll take the opportunity and welcome you, sir, for today's session. Over to you, sir. Thank you.
Thank you so much. I'll share my screen. Let me know if it is visible. Just a second. Yeah, is the screen visible now?
Yes, sir. It's
All
visible.
right. And my voice is also loud and clear. I can
Yes,
start, right?
yes, sir. Yes, sir.
Yes, sir.
All right, great. Thank you so much for inviting me and giving me this opportunity. Since you have already introduced me, I'll not take much any more time for this. My website is mentioned on the slide, anupamrumta.com. So participants can maybe later go on to the website and see our work. I'll straight away start with the session. And a few things to show up before we start. So the topic, I'll just lay down the topics we are going to discuss today. Number one, mistakes to avoid in stock market. Now, why are we talking about this one particular thing, mistakes to avoid? So this is a quote by Warren Buffett. He says, I really believe it is better to learn from other people's mistake as much as possible. Now, this is very easy to say that you should learn from other people's mistake and not make all the mistakes yourself and do not reinvent the wheel. All these things are like, we know that, right? But knowing something and implementing something are two poles apart. And I have seen this so closely in stock market. In almost every investor I interact with, they are making the same mistakes which their seniors or their elders or their parents have already made. And after 10, 15, 12 years, they're like, now I have gained experience, now I will not make these mistakes. The point is, you can save those 10, 15 years of your financial life if you learn from others mistakes in the true sense, right? And that's exactly what I'm going to cover today in great detail, so that you don't make those mistakes and you can save those 10, 15 years of your life. Yeah, that's why this topic becomes very important, and this is the most detailed topic in today's session. Then there is a very common saying in market: higher the risk, higher the return. All right, before I go ahead, I would like to see if the chat is functioning properly. So can the participants give a hi in the chat box, or answer this question? Have you heard this saying, higher the risk, higher the return? Anyone? Write a yes in the chat box if you have heard this, that yes, higher the risk, higher the return is something I have heard or I believe in it, whatever the answer is. Have you heard this statement, higher the risk? If you want to make higher returns, you have to take high risk in investments. You have heard this? All right, I'm getting a few answers now. All right, got it. Perfect. So I'm going to bust this myth today. So this belief which people have got, that the more risk I take, the more returns I will make, I'm going to bust this myth. And this is one of the reasons why people have made huge losses in the stock market, because they go behind those investments which look risky, and thereby they believe that since this investment is risky, this will give me more returns, which is very far from the truth. Yeah, and I'll tell you about this today. Then I'll briefly share about, I'll share a small video on Warren Buffett, and we'll see what is he trying to say on investing. Then we'll cover up briefly about mutual funds as well, where I'll talk about past relevance of past returns and also skin in the game. I'll explain more when we come to this topic. All right. A couple of disclaimers. This is purely for education purpose. We are naturally going to discuss stocks, schemes, and sectors in this session, but do not go and start thinking that this is a stock advice and you should buy and sell according to that. Don't do that, because this is what 99% of the retail investors do, and that's a mistake. And incidentally, 99% of the investors do not make money in stock market. So don't be in that majority, at least when it comes to stock market. Yeah. So don't keep looking for tips. I get to know some good stock or good scheme and I'll go and invest and I'll make money. It doesn't work like that. It doesn't work. Yeah. If that was possible, we would have got many more millionaires in the country, not just a few. Yeah. So please stay away from that. All right. So let's start with the first example of a mistake. Now, when you talk about any stock or any company, any listed stock, they've got something called annual report, right? And this annual report is like a treasure. You get to learn so much from it, about the company, but typically investors do not feel like, or they don't have the motivation or the time or maybe energy to go and read anything in that annual report. They, as I said, we are all looking for tips. We get to know something, we just crave for those recommendations and tips, and we want to invest and make money, but it naturally doesn't work like that. Now a question to all the participants: this is a screenshot of one table in the annual report of this company called Ruchira Papers, latest report, financial year 2021-22. Tell me, what is your observation by looking at this table? Now, this is if you look at the title, transactions with relatives of key managerial personnel holding office or place of profit. Basically, this is the salary of those people who are relatives of the senior management or the owners of the company. What is your observation when you look at the screen? I'm looking at the chat now. Look at the look. I hope you can all see the screen. Tell me, when you look at this table, what is your observation? Anyone? I believe we are also getting chats on the attendance, which must be a part of your requirement. Okay, Lavanya says every employee has got same salary. Perfect. Now, good point. Now that's exactly what I wanted to point out. The point here is this salary is 55 lakhs. This is not some fresher salary. I don't mind if TCS, Infosys, or companies like this come and hire students in bulk from a college and give them same salary. That is fine. That is a starter fresher salary. But 55 lakhs is something which senior people get, right? And it is highly unlikely that all these 7-8 senior people are giving same contribution to the company. It's not practically possible, right? Let's deep dive into let's look into further this table. There's one more table given after this in the annual report. You look at from this point number 5, so 6 people are mentioned here. They have different age, different departments, different education, different level of experience. So ranging from Mrs. Praveen Garg, who is heading the CSR, the Corporate Social Responsibility Department of the company. She is 75 years old and she is getting the same salary. Then we have Deepan Garg, 46-year-old, and 42, 45, 36, 34. So from people from 34-year-old till 75-year-old are getting the same salary. They have the same level of education, graduation, BTech, MBA, BTech, post-graduation, and they are handling different departments: CSR department, VP technical, VP marketing, VP administration, VP operations, VP commercial. Right now, what is typically happening here? This is a family-run business. Nothing wrong in being a family-run business, but it is not run professionally. This is like चाचा मामा ताऊ सब बैठे हुए कंपनी में, उनके बच्चे भी बैठे हुए. They don't want to, they don't want any family dispute. They don't want any altercations in the family and the company. So no matter what they are doing, they all are given the same salary, and this is a hefty salary to give. I'm sure most of them are not even contributing anything to the company. They just have a chair and a table where they can go and sit. They have maybe a nameplate outside their cabin. And I mean, look at this. CSR department is like the most insignificant department. I'm not saying social responsibility is not important, but from a company's perspective, CSR department is the most insignificant department, right? And a lady 75-year-old is managing that. Again, I'm not saying a woman cannot manage. Don't take in the wrong direction. All I am saying is this simply shows it's a family-run business. They just want to pull out as much money they want to from the company, irrespective of what happens to the minority shareholders. Who are minority shareholders? People like you and me who invest small quantity in the stock market. So these are the type of companies you should stay away from. Now, what typically happens? You get some Telegram group or your friend circle or your colleagues or anyone recommends you go and buy this company, you simply go and buy. You don't bother to check all this, because maybe that investment is also for very short term and you might looking for some quick money. Again, that doesn't work most of the time. But this simply tells you that management is not shareholder friendly and you should stay away from such companies. And this information is very, no, this is not fraud. Please understand, this is not, there is nothing wrong legally in this. This is a bad practice. This is not a fraud. That's why they're able to disclose openly in the annual report and get away with it. Because people like you and I, most of the investors don't even look into it. We don't care, right? And that's what they are taking advantage of. So stay away from such companies. This is very clear that you should. They're just taking out money from the company. Now, next, there's something called related party transaction. Let me explain you an example. Company lending to promoters and vice versa. Now, let's say there's a company ABC Limited which is listed on the stock market, right? And let's say I am the promoter of that company. And as a promoter, I have one company which is listed. I have got another company which is a private company. It's not listed in the stock market. It's a private company. There are some other business activities going on with that company. So as a promoter, I have got two companies. One is listed in the stock market. One is not listed in the stock market, right? So my listed company can lend money to the promoter company, to the other private company, and vice versa. Private company can also lend money to the promoter company. So because I am the owner for the both, so I can take decision. I can take the final call depending on what my wishes. Right now, this is what happens: lending to promoter at interest-free or cheap rates. So whatever is the interest rate going in the market, if you lend at that rate, it makes sense. But if I'm giving money from listed company to a private company for free, again, that's a wonderful example of taking out money from the publicly listed company, right? Let me give you an example. This is again a screenshot from the annual report of Virat Crane Industries. Look at this. Advances. What is advances? Advance means you've given a loan. You've given some money to the company. There's something called Virat Crane Agritech Limited and Crane Infrastructure Limited. They have got 6.31 crores. This is in lakhs, 631 lakhs. So 6.31 crores and 2.13 crores. Around 8.4 crore rupees have been given to these two companies in total, right? And where very interesting line has been written below the table. No interest is being charged on the above advances. No interest is being charged on the above advances. Now, how do I know these two companies belong to the promoter? Because this section of the annual report is called related party transaction. It naturally mentions only about those companies in which the promoter has ownership. So these two companies are owned by the promoter of this company called Virat Crane Industries Limited, and this Virat Crane Industries Limited, which is a listed company, has given 8.4 crore rupees in total as a loan, that to interest-free loan to these two companies. Now, this is for annual report 2013-14 I'm showing you, right? Maybe they have paid it back. Yeah. So let's check the latest report, 21-22 report. This is the 21-22 report, and I'll just pull out the previous report from the last page, the screenshot. These are two companies. So Virat Crane Agritech was 631.44. Same company is 634.28. So that loan is still going on. Crane Infrastructure Limited 2.13 has gone down to 9.26. So they have given some money back. But interestingly, two more companies have been added, which have got 2 crores and 4.35 lakhs. So in total, the amount of money which has gone to the promoter company is same, around 8.4, 8.5 lakhs. This money is never going to come back. And let's read the 3-4 lines on the top of the table. The terms of the repayment do not stipulate any repayment schedule, and the loans are repayable on demand. Now, why will I demand money from myself? I have paid money from my listed company to my other private company. Why will I demand money from myself? I will not do that. The loans bear no interest. The loans to Virat Crane Bottling Limited and Virat Crane Agritech Limited are outstanding for a long time, and no provision has been considered by the management in the accounts. Such honest people, right? In your face, they are doing it. And again, this is not a fraud. It's a call. It's a business call by the company. There's no law which says that this is wrong. This again is a bad practice. This is a way to take out money from the listed company and use it for the personal use. So this is not a fraud, else they would have not disclosed in the annual report. This is just a bad practice which is bad for the shareholders for sure. And they are doing it in our face. It's like a tight slap in our face, and they get away with it. Why do they get away with all these things? Because no one cares to read the annual reports. Very small, insignificant minority, handful of people in the country read the annual report, and they don't even care. I mean, even if you read, what can you do? At best, you can do is you can avoid this company. But the point is, we are in minority. People who read the reports are in minority. People who do not read the reports are in significant majority. So trading is happening in the company. People are buying and selling the shares in the hope of making quick money, and management can do whatever they want. So this is what is happening in every industry, not every company. In most of the companies, in almost every industry, this is happening. It's for you, and you have the data available in front of you readily in the annual reports. It's for you to dig out and find out. Yeah. So just to reiterate, I think this was not mentioned. I'll be taking questions in the end. So maybe you can keep putting your questions in the chat box, and then maybe in the end we'll go through it. Yeah, I hope this is making sense so far. All right. So before I go to the next mistake, let me give you a context. Again, a quote by Warren Buffett. He says, because people can make decisions every second with stocks. So you can buy and sell stocks every second when the market is going on, right? So right now the market is going on, you can go and buy and sell every other second. As opposed to investing in a physical entity like stores and farms. You can't, buy and sell your land every second, or your store or your shop or your, any physical entity. You cannot do that. Because you can do this in stocks and not in physical entities, they think that investment in stocks is different than investment in a business, but it isn't. Now, this is the context which you can carry for your entire life for your stock investing journey. The point here is very simple. When you're investing in a stock, there is a business behind that stock. You're not playing in some casino with chips. You are investing in businesses. When you invest in Reliance, Reliance is a name of a business. When you invest in SBI, SBI is name of a business. When you invest in Eicher Motors, Eicher Motors is name of a business. There is a business behind all these names. So it's very easy to say again, but start thinking like a business person. When you're buying a stock, when you're buying 5 stocks, you're investing in 5 new businesses. When you're selling a stock, you are selling the existing business. Now, to give you an example, would you buy and sell? Would you start a new business every now and then? No. Would you sell a business every now and then? No. Would you just buy a business on someone's recommendation? Will you start doing a business just because someone told you within like one day? No, right? But you do all this when it comes to stock market. And that's what creates a difference between a successful and a not so successful investor. Why do we have minorities making money in stock market across the world? Not because they have something extra information. No, I'll talk about information also, the aspect of information in this session, but not because they have got a lot more information. Information is readily available to all of us, including you, me, and everyone. But they have got something called the right temperament. That's why those minority are making money and majority are not. Yeah. Right. So next one, again, we're continuing with mistakes to avoid. Being active and looking for new opportunities, that's again a mistake which people make in the stock market. Now, first question you should ask yourself, within this being active, there are 3 points. First question you should ask yourself is, how boring is my investment? So the more boring your investment is, the more returns you're likely to make. So trading and speculation, when you frequently do buying and selling, it is exciting. Whereas long-term investment is boring. Take an example. Let me ask you a question. You might have seen people, maybe it's the case with your family as well, and your neighbors and cousins and extended family and colleagues and all. They have got properties worth crores of rupees, which was bought like 20, 30, 40 years back by their father or by their grandfather. Yes or no? Have you heard such cases wherein the family has got properties worth crores of rupees, and that property was bought long back by their father or grandfather? Yes? Yeah, we're getting a few yes in the chat box. I'm asking a little less questions, in fact, because I think there's a lag. But yeah, whoever is watching live can maybe answer immediately. Yeah. Now, do you think property investment is exciting and very entertaining? It's not. You can't go and sit in front of your property like this every day, and you start having fun, and it will go up and down. The price will go up and down. No, right? It's a boring investment. So why people have made money in property is not because it has given very high returns. No, the returns in property have been below the returns in equity market. If you study in detail about stock market, you will realize this. The returns in property market have been below the returns given by the equity market. But people have lost money in equity market and made money in property. Why? Because in property, you can't do buying and selling very frequently. And that is like a blessing in disguise. It can be troublesome at times when you want money and you cannot sell your property, but that's like a blessing in disguise, because you end up keeping the property for 20, 30, 40 years, and even with average returns, that property becomes so huge that it becomes a huge asset for your family. And that's a boring investment. That's not an exciting investment. So if you are, see, understand, when you go for entertainment, when you go to a casino, or let's say you go to watch a movie, you pay for it. You pay for entertainment. You don't get paid for it, right? So if you're having fun in your investments, if you're excited every day in the morning and doing trading, you have to pay the cost for it, and one day or the other. You can't have entertainment and make money also at the same time, at least not in stock market. Yeah, I can assure you that you can do. I mean, again, you can learn it from your experience, and you can read books and learn from others' experience as well. Right. Now, a couple of quotes on this. If investing is entertaining, if you are having fun, you are probably not making any money, because good investing is boring. We continue to make more money when snoring than when active. I hope that made sense. Yeah. Another one. Now, I get this question very frequently from investors: ki koi naya stock batao. Tell me some new stock. Again, everyone is looking for new investment. You want some excitement, some entertainment, something interesting happening every now and then in your portfolio as well. In every aspect of life, we are actually looking for entertainment. Yeah. Now, this is a common curiosity amongst investors, but please understand, again, we are investing in business. We are not investing in just some chips in casino. Finding a new company, a new business which is fundamentally strong cannot be a frequent activity. It's not practically possible. Yeah. So just think about it. Can you figure out a new business to start every few weeks and every few months in which you will spend your time, money, and efforts? No. So when you cannot do it physically in your life, what makes you think you can do it in stock market? The only difference is in your actual life, you will do business physically, you will be involved, you will be in charge of everything. In case of stock market, you are not in charge of the business, but you are investing in business ultimately. So the context remains the same, the platform remains the same. You have to think like a business person. Even if you are in a job, doesn't matter. You might say, I'm in a job, I don't have the business mindset. Either you hire an advisor who has a business mindset, or you don't invest, simple. Or you develop that mindset. You don't have a choice. If you want to make money in equity market, you have to think like a business person. Doesn't matter what are you doing professionally. Yeah. Okay. Before I go forward, anyone in this in the audience, I'm asking the students especially, who are maybe doing some side hustle, making some money here and there, and investing in stock market right now? Anyone? Yes, no, maybe. Anyone in the you can write in the chat box, in the comments. Anyone who is making some money here and there, or maybe you're getting money from your parents as a pocket money, and you're saving that money and investing in stock market right now? Anyone? And since when are you investing, if you are investing? I've got a few yes. Most of the people are saying no. All right. So those who are saying yes, I believe whatever I'm sharing, you can relate it to a little more. Those who are not investing yet, I believe, since you are in this, the kind of education you are taking, you and the fact that you will start making money very soon when you get into the job market, or you start something of your own, this will help you a lot when you implement it in your portfolio, actually, right? All right. Now, again, continuing with being active. One more problem is people open their mobile every day, their mobile app every day, or maybe the TV every day, and watch where the stocks are going. You might have seen maybe your parents doing that, your father doing that, or your people around you doing that in the stock market, because they believe it is risky not to keep a track of my portfolio. I have to watch the stock price every day. What if it falls down too much and I don't pay attention to it? So again, the point is, if you had that mindset of a business person and you did thorough research before putting your life's savings into it, if you have done that, there is no need to watch it daily. I always tell my investors, invest in stock market for 5 years plus. If you need some money before 5 years, that amount of money should not go into the stock market. Only that money which you can forget for 5 years, only that money should be invested in stock market. Be it direct stocks or be it through mutual funds. It's the same thing. Right? So if you're doing thorough research from long-term perspective with long-term vision, you really don't have to track your portfolio daily. In fact, if you're tracking your portfolio daily, that is risky. It is not risky to not track your portfolio. It is risky to track your portfolio, because the more you track, the more you will do buying and selling, the more you will panic, and the more you will lose money in the long run rather than making money. It is counterintuitive, but that's how it works practically. Again, information versus temperament. Right? Now, let me give you an analogy. You might have seen people using tissue paper to take out that extra oil from kachoris and samosas, right? I'm sure some of you do that as well. So when you press the tissue paper hard on tikkis, pakoras, and kachoris, the only thing you reduce is your guilt and not the fat. So maybe the fat reduces by 10%, but guilt reduces by 90%. Yeah, I'm sure you know that, but just to, that psychological thing, you want to reduce your guilt. So you put that tissue paper and you take out some oil and then you eat it. Similarly, when you watch or check your portfolio daily, the only thing you reduce is your valuable time and not the risk. Just because you're watching it daily does not mean you will reduce the risk. In fact, your risk will remain same, or it will rather increase, because you are tend to take more and more actions, more and more buying and selling, and your broker will become rich, not you. Yeah. So I've written a couple of lines here with respect to in the context of this. I'll just share those a couple of lines. Stock market में रोज जाओगे means you go and open your TV daily, your television, you're watching the new stock market news and the stock prices. You're opening your mobile app daily and buying and selling every day, or every other day you're doing that. So stock market में रोज जाओगे तो रो जाओगे. You will literally end up crying. Stock market में रोज जाओगे तो रो जाओगे, कम आओगे तो कमाओगे. What it means is, the more passive you are, you buy and then you wait for very long. You keep on watching the business. I'm not saying don't watch at all. I'm saying watch the business. Watch what is happening in the business activity of the company, not in the stock price. Stock price will fluctuate for many reasons in the short term. In the long run, it will follow the business fundamentals. So I am active in doing research. I'm not active in watching the stock price. There's a lot of difference between the two. Right? So the less you go in the market in terms of buying and selling, the more money you will make. So as an investor, stock market में रोज जाओगे तो रोज आओगे, कम आओगे तो कमाओगे. So these all things might look very obvious and common sense, but when it comes to implementation, we all know common sense is very uncommon, at least when it comes to implementation. Yep. Further, I'm still talking about mistakes to avoid. Next mistake, a very common mistake, which those who said they're investing might also be making in every now and then. Predicting the movement of stocks and stock market. That now this stock price is expected to go up, this stock price is expected to go down, or the market in general is expected to go up or expected to go down. According to that, you invest or you take out the money. Again, it doesn't work. Right? So again, I get questions from investors. Elections are coming, or state elections are happening, or during the time of Lok Sabha elections, or when the budget is coming, or before and after COVID. That what do you think will happen now? What new stocks are you buying after elections or after budget or after COVID? So again, it doesn't work like that. Yeah, so you keep on predicting, expected to go up or expected to go down after this, so and so. It doesn't really. I mean, you can't really predict that and make money in a sustainable way. That is the point. Right? Now, 50% price down, what more can happen? Again, a very common mindset that this stock price has gone from 400 rupees to 200 rupees. Now this looks like a very good buy. What more can happen? What worse can happen? It has already gone down to so much. So there are many examples in the history to show. Some examples are Yes Bank, DHFL, Manpasand Beverages, and Vakrangee. Just look at their stock price, the way it went down 50%, then further 50%, then further 50%, and so on. So the more you rely on the stock price, the more you will lose in the stock market. The more you will rely on the business fundamental, the more you will make money in the stock market. It's as simple as that. And there is no rocket science in this. Yeah. The best one, expected to market is expected to go down. I will sell my portfolio right now and buy again at lower prices. Now, this is something people did a lot in 2020. So from March, April 2020, when the lockdown happened and the market tanked like 35% in very few days, everyone around was saying that, this is just a trailer. Picture to abhi baki hai. There's a lot more to come. And it was logically they were right. I mean, the lockdown has just happened within few days, and market has gone down, and business activities are at a standstill, and we are yet to see much worse. And I know a lot of people. By the time July, August came, the market had recovered to a large extent at their previous levels of Feb and March 2020. And again, logically, everyone started saying this is unsustainable. This is like absurd. Why would the market go up so much? It is definitely bubble. So I will sell my portfolio right now. Within 2-3 months, the market will go down and crash down badly for sure. And then at that further 20, 30, 40% discount, I will enter again. This is something which happened with a lot of investors in July, August, September 2020. We are sitting in September 2022. We know how the market has gone in the next 2 years, from 2020 September till 2022 September. So again, prediction. I mean, out of 10 times you predict the market, maybe you get right 5 times, but you will get wrong 5 times. Your net result will be either 0 or negative. I'm not saying you will be wrong every time, but the point is, if you get into that habit, it will be very difficult to leave it. Yeah. So it is very tough to develop good habits, but it is even tougher to leave the bad ones. I don't have to convince you on this. I know a lot of you, all of us, including me, have got some or the other bad habits. We are trying to leave that bad habit for last 1 year, 2 year, 5 year, 10 years. We have not been able to do so. So the point is, don't get into any kind of a bad habit when it comes to stock market investing. Because once you get that habit of predicting the market and being active and trading and all that, it's very tough to get out of it. No matter how much you understand that it is not good for you, you will still not be able to do it. Yeah, I hope it is making sense. Can you write a yes in the chat box? If it is making sense, if you're getting what I'm saying, just write a few yes in the chat box. Bhavesh is asking, what about traders who daily earn money by doing technical analysis? Very good question, Bhavesh. So my question to everyone here is, how many people do you know who are traders and are there in the top 500 richest people in the world? How many traders, short-term traders, technical analysis, future and options, currency, commodity, this and that, how many people do you know who are in top 500 richest people of the world? None. If they're really making money every day, why are they not there in top 500? And technical analysis is not something new. Trading is not something new. Trading came before fundamental analysis. So I am skeptical of people who are claiming that they are making money every day. They are making money by your viewership. You don't know how much money people are making on YouTube. You have no clue. You will be shocked. You don't know how much money people are making by selling their courses. Nothing wrong in that. Nothing wrong in selling courses. Nothing wrong in teaching. But the point is, you as an investor, you should know what you are getting into. But you will find a lot of fundamental people who are doing fundamental analysis and long term. They are there in top 500 richest people of the world. Why? That gives you the answer. So those who are claiming they are making money every day, why don't you take their services and make money every day? Who stops you? They will become the richest person in the world, and you will maybe become the second richest. I'm not pointing out to one person. I'm just telling you everyone, because this is a very genuine question, and there are so many claims going around in the market. I make money every day, every week, and I made so much money in 1 month, so much money in 2 weeks. It's not sustainable. And the point is, again, elaborating on this, how typically it happens. Just think about as from a human angle point of view. Let's say there's an investor who is doing trading, active trading every day, day in, day out. In my opinion, that person will lose money in the long run for sure. Let's say on a particular day, he made, in a particular week or on a month, he made 10 times money in a stock. He made his, got his money, from X to 10X, right? He will go and tell about this to 100 people. including not only hundreds of groups and everyone, thousands of people, he will tell that I made so much money. But in the last 4 years, he has lost much more money than that, and in the future also he will lose money. He will not go and tell everyone in the WhatsApp group, today I lost money. Now this is like a biased information which is going in the market. Now everyone around is like, oh, this idiot made so much money. This idiot, he was a duffer in college and school. He's making so much money in stock market. I am any day more intelligent. Why can't I make money? And you also get into that same trading, and it's gambling basically. You cannot make money through gambling and entertainment for sure. You are getting entertained when you're doing trading actively per day, and entertainment has got a cost. And the information which is coming in the market is a biased information. You only get to know the good news. You don't get to know the bad news. Because why that person's ego will be hurt. Why will he go and tell the market I'm a fool? Why will he go out and tell the world and to his friends that I'm a fool, I'm losing my money in the market? He will tell he will share only the good news in the market, not the bad news. And unfortunately, again, as I said, people don't learn from others' experience. They learn only from their own experience. After 10, 15 years, they're like, okay, now I understood. This should not be done. But the way you can save yourself is by reading books. There are so many books with so much of wisdom there. Please start reading those books. You just need to read like 5 to 7 books on stock market fundamental analysis, and you will start thinking straight in terms of what is practically possible, what is not practically possible. Yep. Again, a few quotes. Far more money has been lost by investors preparing for the corrections or trying to anticipate corrections than has been lost in the corrections themselves. So again, people were doing the same thing in July, August, September 2020, that the market will correct now, the correction will come, the market will go down. And in that anticipation of correction, they did some trades, selling and buying, whatever, and they lost much more money than they would have actually lost in the correction. So again, predicting the market doesn't work. Short-term market forecasts are poison, and short-term means less than 5 years. Short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from the grown-ups who behave in the market like children. This is one of my favorite quotes. This is what again, as I said, majority people lose money in the market. This is what majority of people are doing. All those who are investing in this audience in the market right now, you would have predicted the market in the past, or you are doing it today also. That it will go down now, it will go up now, this stock will go up, this stock will go down, let me invest. You are least bothered about the fundamentals of the business. Just being hopeful and wishful that you will make money will not make you money in the market. That's what everyone else is doing around you, looking for tips and recommendations. Have they made their money? When the bull market is going on, 2021, 2020, all the last 2 years, everyone has made money for sure. But is it sustainable? Of course not. It is sustainable only when you do research, or you rely on research. Next one, we are still continuing with mistakes to avoid. Herd mentality, bhed chal. Might have heard bhed chal, right? So investors' tendency to follow what other celebrity investors are doing or what public is doing. So what public is doing is available on CNBC, and what celebrity investors are doing is also available on CNBC or other channels and maybe YouTube channels and all. You keep on looking for what big investors are doing. I will also do the same and make money. Again, it does not work. So most of you were maybe just born in the dot-com bubble. This was in 2000, 2001. And every IT company, every tech company was trading at very, very high valuations, and everyone was like, when every company is trading at high valuation and everyone is buying it, then what's wrong? Let's buy. So everyone lost money. 99.99% people lost money. I mean, big deal. I mean, you just because you are with the majority does not mean you will make money. In stock market, it works the other way around. Now, why would you lose money even after copying successful investors? Now, before I answer this question, think and tell me in the chat box, why do you think you are bound to lose money even when you are following successful investors? Think. I'll give you a few seconds. Why do you think you will lose money even when you are following successful investors in terms of what they are buying, you're also buying? Why do you think you will lose money? How do beginners buy a stock? It's not about beginners or mature people. I mean, are you asking logistically or are you asking in terms of research? Whether you have zero experience or you have 30 years experience in stock market, you have to do research, or maybe you have to hire someone who's doing research for you. Open a demat account and start buying. That's what, right? Market changes. Okay, what else? Because a mindset of everyone is different. That's right. Good. By not doing proper market analysis, but because the celebrity investor, the successful investor, has done the market research and he's buying those stocks, why should I not follow? Since many investors believe in long-term investment and not in short-term investment. Yes, so maybe you're following someone, he's into long-term and you're into short-term. So in short-term it might go down, but in long-term you will still make money because of manipulation. Okay, so maybe the big investors are manipulating. Okay, what else? Sir, can you please explain the fundamentals? So it takes me 18 hours in my program to explain the fundamentals. It's not possible in a 1.5 hour session, but I'm just giving you a gist, a context of how to look at stock market. If you get the context right, you will at least move in the right direction. That's more important. Because if they sell, price will reduce. Okay, this is one thing. A successful investor is buying a stock. Tomorrow, if they go and sell, the price will reduce and you will lose money. Okay, that could be one reason. What else? Mindset and experiences are different. Okay, because we always predict what is happening, what is going to happen in the future, and we follow other people's tips. Got it? Market changes. Okay, it needs deep study. Okay, good points. So let me give you whatever you said is right. Whatever you all shared is right. Let me give you the nitty-gritties of when you are following someone, how you should follow if you really want to follow. Let's take an example. First of all, you do not copy as it is. You want to copy of investor, but you're not copying as it is. What does it mean? Let's say a successful investor, Mr. X, bought shares worth 200 crore rupees in a company. Now this news comes out, in the market that so and so investor bought shares of so and so company worth 200 crores of rupees. And everyone around is like, oh, this company must be the next multi-bagger or next, big investment, and let me go and buy. Right? The point is, 200 crore rupees is a big amount for you and me. Did you see what is the total worth of that investor? Again, common sense, which is very uncommon. Did you notice the total portfolio size of that investor? Let's say this is 2% of his portfolio, and you will see this every now and then. Look at the past news of Mr. Rakesh Jhunjhunwala. Whenever he has bought a stock, it becomes like a huge, big breaking news. And then look at the proportion of that stock in his overall portfolio. So that investor has got, let's say, 40,000 crore worth of portfolio. 200 crore out of that is, 10,000 crore worth of portfolio. 200 crores out of that is just 2%. You had 1 lakh rupees with you. You went and invested 20,000 out of that, which is 20%, not 2%. Or you had 10 lakh rupees with you. You went and invested 5 lakhs out of that in that company, which is 50%, not 2%. Can you see the conviction level that big investor has got in this company? He's investing just 2%. So if you really want to copy, and let's say your portfolio size is 1 lakh rupees total. What is 1 lakh, 2% of 1 lakh rupees? 2,000 rupees. Go and invest 2,000. Who is stopping you? But you're not even copying as it is. His conviction level is this much in that stock. Your conviction level becomes this much. Now, if the stock goes down by 50% in the next 5 years in the long term also, it will hardly make any difference to this investor. But it will make a huge difference to you. Because you have invested 20, 30, 50% of your total wealth into that company. And then we will like, oh, these big investors, they fool the small investors. Only the big people can make money in the market. Stock market is not my cup of tea. It is not in my destiny. And FD is this better and this. I mean, these all typical statements come out now. No one can manipulate. I mean, people have manipulated the market to some extent. In some cases in the past, the regulations have got very, very strict in the last few years. And it's getting stricter by the day. In the long run, no one can manipulate any stock. In the short run, few days, maybe they can. In the long 5, 10, 15 years, no stock can be manipulated for that long duration. So when you invest for long term on a fundamental analysis basis, you will not lose out. I'm talking from portfolio point of view. I'm not saying you will make money in every stock. Out of 10 stocks, you will still lose money in 2. But overall portfolio will make money. Right? So you got this context that why you may not make money, because you're not copying as it is. Right? Now, another point within this not copying as it is. Mr. X, who is a successful investor, has got 10 stocks in the portfolio in a certain proportion. Right? You liked 4 stocks more and you bought them and you ignored the other 6. Because you also did some, some YouTube surfing, you watched some videos, you read up maybe a couple of articles or maybe some news here and there. You asked your friends and colleagues and your seniors and your parents, and they said, okay, this stock looks better, and you went and bought only those 4. Now you look at any successful investor across the world, dead or alive, out of 10 stocks in their portfolio, they have lost money in minimum 2. I'm talking about the super successful investors, not average investors. Out of 10 stocks in their portfolio, they have lost money in minimum 2, maybe 3, maybe 4. They have made exceptional returns in 2 out of 10 and average returns in remaining 4 or 6 stocks. That's a typical performance of a well-researched portfolio. No matter how successful you are, you will lose money in 2 or 3, you will make very good returns in 2 or 3, and you will make average returns in remaining 4, 5, 6. Now, when you pick 4 out of 10 stocks, you don't know whether you pick the good ones, the average ones, or the bad ones. If you really want to copy someone, please copy as it is and in the same proportion. Yeah. Next point. Now, with this point, you will realize that even copying as it is not possible. In the first point, I said, first train your brain to at least copy properly. Now, in the second point, I'll tell you why it might not be practically possible to even copy it properly. There's something called norms by SEBI, which is the regulatory authority for stock market in India. The law says a company has to disclose in shareholding report, it's a report which comes every quarter, when stake of any individual or institutional investor crosses 1% in a company. What does it mean? Let's say Mr. Rakesh Jhunjhunwala has got 1% or more ownership in a company called Titan. So his name will come in this shareholding report along with how much percentage of the company he owns. This is a law by SEBI. The moment that stake goes below 1%, his name will stop coming in the report. Got this law? Clear? Only your name will come in the report. So basically the public will get to know that you are owning that stock only when you own 1% of that company, not 1% of your portfolio size, 1% of the company's size. If you're not owning 1% or more of the company size, your name will not come in the report. Right? Now, this is the strategy implied by the big investors, which is that there's nothing wrong in that. Please understand, they're investing and they want to make money, which is nothing wrong. You also want to make money. Now, what they do is, they know the moment I cross 1%, my name will come in the public. So they will start buying 0.1, 0.2, 0.3% of the company and gradually increase it over the years, 0.4, 0.5, 0.6, 0.7, 0.8, 0.9. Over a period of 4, 5, 6, 7, 8 years, they bring it to 1%. The moment it touches 1%, their name comes in the next shareholding report. And the entire investor community is like, oh, this investor bought stocks worth 1,000 crore in this company. And everyone starts going and buying that company. You realize the problem in this? I'm sure you did. So first of all, as investors, we do not know since when that investor is buying that stock, number one, and at what is the average price at which he has bought that stock in those 7-8 years. And we are buying at today's price. He has been buying for the last 5, 7, 8 years. And the same thing happens when you sell the stock. Let's say they bring it up to 1.1% of the stake, and after a few months or few years, they bring it down to 0.9. So their name will stop coming in the report. Now, as an investor, I do not know whether they have sold the entire stake or they have brought it down to 0.9 or 0.5 or 0.1. I would not get to know. And even when I get to know, I'll get to know it with a delayed information. Why? Every quarter, what is quarter? Jan, Feb, March is 1 quarter. So let's say they did a transaction in January. So Jan, Feb, March report will come in April. So in April, I'll get to know that this investor has bought more than 1% or sold, gone below 1% in the last quarter. When in the last quarter, at what price, I don't know. So even if you want to copy someone, you can't. So you must have heard this Hindi saying, "Nakal mein bhi akal chahiye." You need brains even while copying someone, right? Make sense? So please be careful while getting influenced or impressed by looking at the stock names of those celebrity and big investors, because you don't know at what price they bought it. You don't know what the allocation is. You don't even know the most of their portfolio. Most of their portfolio, the stocks they are buying are below 1% of the company's net worth. So you don't even know when they own those stocks. You only have that public information, which is through shareholding report. You think you know Rakesh Jhunjhunwala's, he's no more, unfortunately. But do you think, let's say Vijay Kedia, do you know his entire portfolio, which is available on some random website? Do you think that's his entire portfolio? Of course not. We might never get to know what is his entire portfolio and in what allocation he has done it. Last point within this mistakes to avoid, then we move to the next topic. I'll talk about that higher the risk, higher the return myth. Loss aversion bias. Now, let's take an example. Let's say you own 5 different businesses. Physically, in your life, you're doing 5 different businesses, right? 3 of them are doing really well, and you expect them to grow further, right? The other 2 are in losses since very long, since you started, and future also looks dark. Now in these 2 businesses, you have done everything you need to do. You have put in more money, you've done more marketing, you have changed the team, you have incorporated a lot of technology, you have done partnerships and joint ventures, and you have done every effort you could do, time, money, effort, everything you have put in. But these businesses are not working, and the future also looks dark. Tell me in the chat box, in the comments box, what will you do? In this situation, when you have 5 businesses, 3 are doing very well, the other 2 are not doing well, and the future also looks dark for those 2. What will you do naturally? Tell me. I'll wait for your response in the comments. Anyone? What would you do when you own 5 businesses, 3 are doing very well and expected to do well in the future, and the 2 are doing very bad? Sell those 2 businesses. Okay. Anyone else? Any other view? What would you do? Think. I want you to participate and think at the same time. As an investor, the best thing, the only thing which will save you from losing money is keep your brain active and keep thinking. You'll sell it. Okay. Everyone is clear you will sell those 2 businesses? Yeah, that's what that's the answer I'm getting in the comments. All right. Now take the same scenario when you hold 5 stocks. What do you do? When you hold 5 stocks, 3 have given profits, 2 have given losses. What do you do? Tell me authentically, those who are investing or those who have heard people investing in their family, in maybe their parents and all. What do typical investor does? 3 stocks are giving profit, 2 stocks are giving losses. What do people do? What do investors do practically in stock market? What happens actually? They sell the profit-making business and keep investing or keep holding the loss-making business, right? So what you are doing in your actual life, that is common sense. What you're doing in stock market in the same situation is the reverse of common sense. So it's not that common sense is uncommon, the implementation of common sense is uncommon. Yeah. So you are investing in not stocks, you're investing in businesses. Whether you do it physically or you do it through stock market, you are investing in business. Please understand that. Please ingrain this in your brain, in your head as much as you can. So your thought process has to be same. Loss, this is called loss aversion bias, is when investors refuse to sell loss making investments. Example, I know people holding Reliance Power for last 12, 13 years. 95% of the wealth has been eroded. The stock price has gone down by more than 90% in the last 13 years since the IPO came. But they're still holding to the stock. Why? Because so much loss has happened. Why? What's the point of selling now? I'll keep on keep on holding this company till it comes back to 100 rupees. Yes Bank, Suzlon, 1%. There's so many examples. So loss booking is an art. So understand that stock market is a combination of science and art. It is more art than science. It is more temperament than information. Everyone has got the information. Temperament is something which is rare. That stock which has gone from 100 to 50, and you also believe that you made a mistake by buying at 100 because a fundamental problem is there. I'm not saying any stock which goes down you should sell. No, maybe a good stock also goes down in the short run, but you know the reason behind that is temporary. So you keep on holding, you keep on buying, and you keep on investing. But when you realize that there is a fundamental problem with the business, at that point in time, even if the stock has gone down by 50%, you should sell and invest that money in a fundamentally sound company, because from there it will go 10 times. This business will not take you 10 times, but the other business will. So don't hold on to those same stocks in the hope of making money from that company only, which gave you losses. It doesn't work like that. So loss booking is an art. It's not easy. Information versus temperament. This is what I believe. Equity investing. When I say equity investing, it means stocks or mutual fund, whatever you do, your money is going into stock market ultimately. Equity, right? So equity investing is 1% information and 99% temperament. So after you have done all the research, you looked at all the ratios and annual reports and this and that, every research you have done, you have scored 1 marks out of 100. 99 marks are remaining to be worked upon. That's how it is. You like it, you don't like it, doesn't matter. That's how stock market works. Information edge was there in 90s. If you have seen scam 1992, the Harshad Mehta scam, he explains there as well that he had the right information, so he made money. This was true in 80s and 90s, and to some extent early 2000 also. Now everyone has got information readily available. There is nothing called information edge. Now it is behavior edge. Now it is temperament edge. You will make money not because you have the right information. You will make money when you have the right temperament. So after whatever research you have done, you have scored 1 marks out of 100. 99 marks are still remaining. So think accordingly. All right. Let me give you an example of one company. Anyone who has heard of this company, Supreme Industries Limited, without searching on Google, tell me what this company is into. What is the business of this company? Akash, saving tax is fine, but how long will you save tax? You can rather make much more money, give tax, and still have more money net of taxes. It's easy to say, maybe 1 year, 2 year, you will like saving taxes, but you are ultimately losing money and resources and time into something which is giving you losses. Would you invest in a company which has got 5 subsidiaries and they're keeping those 2 or 3 subsidiaries just to make a tax advantage? No. So when you will not invest in other businesses which are behaving like this, why will you do it yourself? Saving tax is fine, but saving tax is not the only goal of investing. Ultimate goal is to make net returns in your hand. Anyone who knows what Supreme Industries does? Anyone who has heard of this company, Supreme Industry? What business they are into? You can write in the comments box. No idea? All right. So this is into plastic manufacturing. You might have seen Supreme Table and Chair. Right. Now that's just one business. They have got more than 5,000 different types of products or different, what do you call it, SKUs, stock keeping units. So you look at the pipelines in the building, plastic pipelines, Supreme. The desktop or laptop you're using, the plastic body part of that, Supreme. Your car, the dashboard of your car, the plastic dashboard of your car, Supreme. Look closely to those blue color crates of Coca-Cola, those in which 24 bottles can be kept. Look closely, the label Supreme. Yeah. In a lot of cities in India, there are dustbins installed after every few meters, after every few 1 or 2 kilometers, or maybe 100 200 meters. A lot of them are by Supreme, right? On in the rainy season, you will see these black and blue plastic sheet on trucks, Supreme. Yeah. So they have got like the variety of products they have got is huge, huge. So we start. Why I'm taking this example. We started investing in this company in 2009, and I'm still holding this company, 2022. Yeah. Let me show you some data of this company. Look at the revenue growth and the profit growth of this company in the last about 15 16 years, and look at the dividend payout. Now let me explain you this last part of the table. Let's say in the year 2000, 2005 2006 they made profit of 39.95 crore, out of which 13.81 crore was given out as dividends, which is 34% of the net profit. What is dividends? It's like, I am a shareholder. The company says I have made good profits. I want to distribute that profit to the shareholders. So depending on the number of shares I have got, I'll get some dividends. So the way they announce is, the way you get it is like 2 rupees per share, 5 rupees per share, 10 rupees per share. So if I've got 100 shares and they announce 5 rupees per share, 5 into 100, 500 rupees is the dividend I'll get in my bank account. So that's called dividend, right? It's like an interest. Now, this is not compulsory that every company has to give dividends. They can choose to give, they can choose not to give, right? So this company chose to give dividends to its shareholder. Now, out of 39, 13 crores are gone. So around 26 are left. 26 was invested further in the company for the expansion of the company. Next year, they made a profit of 50 crores, 50.15, out of which 20 was given out as dividends again. 30 was left. Next year, they made a profit of 51, out of which 22 was given. Then next year, 97, 30 was given, and so on. So every year, they are making more and more net profits, and they're giving a significant portion of that as dividends to its shareholders, and they're still growing, right? Now, when we started investing in this company in year 2009, it was trading at somewhere around 20-21 rupees. It went up to 2,500. Right now, it is trading somewhere around 2,000 rupees plus minus 100-200 rupees. So it has gone up by 100 times in 13 years. So if you invested 1 lakh rupees in 2009, you would have got 1 crore rupees in your account today in 2022. And the best part, in these 13 years, they have given a dividends of 7.5 lakhs rupees on an investment of 1 lakh. So let me repeat. If you invested 1 lakh rupees in this company in 2009, you would have got stocks worth 1 crore rupees in your account right now. Plus, in the last 13 years, gradually, you have got dividend worth 7.5 lakh rupees. So you have made much more money in dividends compared to what you invested. Right? So this is one of the companies in the portfolio. Now, please don't go and buy this company tomorrow. This is one of the companies in my portfolio. You don't even know the allocation. You don't even know whether I'm still buying more or I'm holding on to it. So please listen from the learning perspective, not from the tips or recommendation perspective. Please change this mindset, because this will not take you far. Right? Now, I'll tell you why am I sharing all this. I'll come to that. Now look at this, the fluctuation in the stock price. In 2009, when we started buying somewhere in March, it was around 21 rupees, and the lowest it was 18 rupees. Highest in the year, it went up to 76 rupees. So look at the fluctuation within a year, right? Last calendar year, Jan 21 till December 21, the highest price was 2612, lowest was 1687. Again, look at the fluctuation. So no matter how good the company is doing in terms of their profit growth and revenue growth and dividend payout, their fluctuation in stock price is natural, because that's how stock market works. That's the basic characteristics of stock market. It will fluctuate no matter how good the company is. Right? Now, what is the worst case scenario and the best case scenario? I started investing in 2009, let's say at the highest price of that company, 76.82 rupees. That's the worst which can happen to me in 2009. And in 2021, I sold this company for the lowest price, that is 1687. So in these 12 years time, the worst which can happen with me is I buy at 76 and sell at 1687. Fair enough? And what is the best case scenario? I invest at 18.71 and sell at 2612. This is the best which can happen with me. Now, look at the right hand side of the table. In the worst case scenario, the money has gone up by 21 times, almost 22 times. The returns are 32% compounded annually. In the best case scenario, the money has gone down by 139 times, and it is compounded annually 48%. And this is excluding the dividends paid by the company. If I include the dividends, the returns are higher. The percentage returns are higher. For the ease of calculation, I just kept it simple. Yeah. So the point is, when you do the stock research and you know the fundamentally what the company is doing, the stock price is bound to fluctuate, but in the long run, you will still make money. There have been times when this company gave losses for 2.5 years continuously. So you bought it, let's say in somewhere in Jan 2018, it went up to 1450, which was like the peak of that company, somewhere around 1470, 80. And for next 2.5, 3 years, almost till November 2020, the stock price was below that 1470 level. So even good companies can give bad returns in the short run. That's why I recommend to invest only for 5 years plus when it comes to stock market. Or have that vision of 5 years plus. You might sell a company before 5 years because you realize something is wrong with the company fundamentally, but your vision should be to invest for 5 years plus. Your money should stay invested in the market for 5 years. Right? Now, you saw the fluctuation in the stock price, 76 to 18, 261 to 16 to 87, and even right now, if you look at this complete calendar year, this 2022, look at the fluctuation, it's very high, right? Now, this is what people call risk. That's why people stay away from stock market in India, right? I bought a stock at 100 rupees, it went down to 60 rupees. Stock market is very risky. The fluctuation or the volatility is what we call risk, right? But tell me, think hard and tell me, is volatility equal to risk? Really? Tell me, what is your view? Is volatility equal to risk? Yes or no? Do you think fluctuation in the stock market is what constitutes the risk in the stock market? Yes or no? It can be anything. Yes, no, maybe. Tell me in the comments box. Do you think the fluctuation in the stock market is what leads to risk? Yes or no? Okay, some people are saying yes. Some people are saying no. Okay, all right. So let me again give you a perspective on this. Volatility is a long-term investor's best friend. Let me add 2 cents to it, provided you have knowledge and patience. Now, if you have knowledge and patience, volatility will act in favor of you. If you do not have any one of them, either knowledge or patience, volatility will be your biggest enemy. For sure. Because even in a company like Supreme Industry, people have lost money left, right, and center. Why? Because they did not have the patience to hold for long, or they did not have the knowledge that why am I investing in this company? They bought the company because some friend recommended. So volatility and risk are 2 different things. Don't mix them up. This fluctuation is your best friend if you are a long-term investor and you have knowledge and patience both. If you do not have this, then for sure it is your enemy. Then it is very risky for you, for sure. Let me tell you one story. Let me take 2 names from the participants. Let's say, all right, let me take one name. All right, let's say me, Anupam, and Neil. We both decided to invest in a plot of land, right? Our budget is around, let's say, 40-50 lakhs, and we want to buy a piece of land for investment purpose, not for building a house and staying, only for investment purpose. We both want to buy a piece of land, right? And our budget is around 40 lakhs, 50 lakhs, something like that. Now, what does Neil do? Neil believes in research. So what he does, he takes out the master plan of the city. Every city has got a master plan in which they tell you what are the future. You can find out what are the future goals of the government in terms of developing which area, and which is the industrial area, which is the residential area, and all those lot of things are there. Now he looks at the master plan. Then based on that, he looks shortlists a couple of areas in the city wherever he's staying in the outskirts, and he believes that these 2 areas might do well. He reads a lot on the news, and he talks to his friends and colleagues and neighbors and everyone to find out that these 2 areas looks the best in terms of future growth potential, right? Now in that area, he finds there are around 7 or 8 developers who are coming out with their plotting project. Now he starts his research on those 7-8 developers. He finds out their past project, whether they were delivered on time, whether they fulfilled all the promises they made in terms of the development, and what is their history and track record and general, impression in the market in terms of their integrity and all. And he finds out that 2 developers out of those 7 8 developers are doing well. Now he goes and visits that area. He looks around. He drives around that area and looks at the townships and development and talks to a few people there and talks to the developer and all those things. And he figures out that out of those 2 townships he had shortlisted, or 2 developers he had shortlisted, one township looks the best bet for his investment. Right now, since he has done all the research, all the background research has been done, and then that township looks good to him. Now he goes to the sales team of that developer and asks them to give him the presentation, which is like their sales presentation, which is there. Now, since the research has been done by him in thorough detail, he is able to ask relevant and tough questions to the salespeople, right? And they end up convincing him that yes, this developer, their project, their paperwork, everything looks clean, and I can go ahead with this developer. Further, he takes the paper from them and get it vetted by the lawyer, get it checked by the lawyer that everything is fine or not, right? So everything is done. He has shortlisted the township. He has got all the paperwork checked. He has done all his research, and now he wants to invest in that township, right? Now, there's still one thing left. He now calls a Vastu expert. Neil calls a Vastu expert, and he tells him that by this plot number 820, this dimension, this direction, this is the best in terms of Vastu. So he invests in a plot number 820, right? Now, there's another investor called me, that is Anupam. I believe in higher the risk, higher the return. I have this theory very well set in my mind, and my parents and my elders and everyone has told me around me that, if you want to make big money, you have to take higher risk in the investment, in the stock market, right? And I believe in this. So what I do, I wanted to invest. I had that money to invest. I saw a full page newspaper on one Sunday of this particular township, and I get impressed with that, whatever location they mention and whatever they mention about the township and the builder. I go to their sales team, their site office. They give me a sales presentation. I get impressed. I cut the check and I book plot number 821. The plot next to Neil. His plot is 820. Mine is 821. No difference. Same dimension, same size, same price. Everything is same, right? And I've bought this plot. Now, both of us want to invest for long term, 5 years, 10 years, 15 years, whatever the time is. And I believe that I have taken this risk. I mean, if I want to make money, I have to take risks. So I have not done much research. I just bought this plot. It's a high risk investment. And I believe in making that. I believe that I'll make high returns in this plot, right? Now, a question to all of you. Given this story, for whom do you think this is the risk is higher? Is the risk is higher for Neil or risk is higher for Anupam? Tell me. In this whole situation, both of us have invested in the same township, adjoining plots, same rate, same price, same everything. But risk is higher for whom? Neil or Anupam? I want to see some answers in the रिस्क है तो इश्क है. ये इस तरह के डायलॉग से पैसे खोए लोगों ने स्टॉक मार्केट में. स्कैम 1992. रिस्क है तो इश्क है. Who is having more risk? Neil has got more risk in the investment, or Anupam has got more risk in the investment? Anyone? I think there is a lag, but those who are through YouTube, there should not be any lag. Yeah, risk is more for Anupam. How is risk more for Neil? Neil has done all the research. He knows what he is doing. Anupam has done no research and he is investing. So risk is more for whom? Anupam, right? Now, after 10 years, both Neil and Anupam sell the plot and they both make good returns, right? But Neil made good returns with low risk. Anupam made good returns, luckily, but with high risk. And I put my collar up and I say, look, I told you, higher the risk, higher the return. I took high risk. I did not do any research and I made good returns. See, I'm right. So this is what is happening in the market. I might make returns once in a while, but if I make 10 such investments without doing research, I will lose money in 8. But I will not tell my friends about those 8 investments. I'll tell my friends about those 2 investments which have done well. I don't want to look like a fool in the market, right? Why will I go and tell people out of 10 investments I made 8 I have lost money? No, I will tell about those 2 investments to 2,000 people. And then everyone will be like, oh, Anupam is a very smart guy, very intelligent. He makes so much money, such good research and whatever. He's a risk taker. Look, he is making so much money. Actually, I'm losing money, which only I know deep down inside. So the actual theory which works in the stock market, if you really want to make money, is this: it is higher the knowledge, lower the risk, and higher the return. It is not higher the risk, higher the return. Higher the risk is higher the losses. Simple. You look at Yes Bank, you look at Anil Ambani companies, you look at JP Associates, you look at 1% beverages, DHFL, they were all high risk. It is actually higher the knowledge which leads to lower the risk, which leads to higher the returns. The more knowledge you have on the subject, the more confident you are, the more calculated risk you have taken, and that gives you much higher returns. And another saying by Warren Buffett: risk comes from not knowing what you're doing. Please get this straight. Take out this risk hai to ishq hai, all these, they are good for dialogues and all that. That's what makes the news, and it makes the series interesting and the movies interesting. But higher the risk, higher the return, risk hai to ishq hai, all these things does not work in practical. I hope this myth is busted by this simple example, that you have to increase your knowledge so that your risk comes down and your returns comes up. There's no other way. There's no shortcut. I hope that made sense. Now let me show you one small 4.5 minutes video by Warren Buffett, and then I'll tell you what all you can interpret from that. So just watch this very carefully. I'll switch on the subtitles as well, because he talks a little too fast and the accent can also be different. So I'll switch on that. Just a second. Let me switch on the subtitles. All right. Can you just tell me in the chat comments box if you can listen to this, if it is audible or not?
The most important thing is to decide, is to be able to define.
All right. I've just put a pause on that. Can you tell me in the... Can you tell me in the comments box if you can hear that to one or two lines? All right, it's audible. Perfect. So let me play it again and just listen to this about 4 minutes 40 seconds, and then we'll talk further.
The most important thing is to decide, is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were at Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "You can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, we'll change what kind of gum they chew." I said, "Well, then I'll stick to chewing gum and you stick to computers." I don't have to understand all kinds of business. There's all kinds of business I don't understand, but there's thousands of opportunities there. I did understand the Bank of America, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram that shows him at the plate. And he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he guess what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 30, you had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me, and you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game, and it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6 billion, $570 million. So annually, $6 billion, $570 million for 1 penny. You think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future. But
All right. I hope that made sense, that video. Let me just share a brief about what he said. So first of all, you don't have to understand thousands of businesses. Now, before I answer that, there's one comment saying that we may make money in stock market through luck. So in my opinion, luck works in 1 year, few months, 2-3 years maximum. A luck cannot work for 5, 10, 15, 20 years. If you're making money sustainably in the long term in the stock market, it has to be skill and knowledge. I mean, that's, again, you can either experience it or learn from others' experience, but that's how it is in any field for that matter. You cannot get lucky in any field, in any job or any business, or be it an investing activity forever. It has to be skill if you are doing it for very long. Right? Anyway, coming to this, you don't have to understand thousands of businesses. Now, you don't have to know about every industry, every stock, so that you can become successful in investing. No. You need only handful of successful companies in your hand in your entire lifetime to make that money. You don't need to have a view on everything. You don't need to read about every damn industry and every stock. Right? Swing, I will give an example of baseball. Swing or invest only when you understand the business. You don't have, again, I told you about being active is a mistake in stock market. Don't believe that you have to find a new stock every few weeks and few months. By the way, in last 2 years, I have not made any change in my portfolio. Last change I made in my portfolio was in September 2020. It's been 2 years. I have not added a stock. I have not sold any stock. Now, not that I was planning in September 2020 that I will not do anything in the next 2 years. It just happens. I might make 6 changes in next 1 year. I don't know. But that depends on the fundamentals of the business. It doesn't depend on just because I have to do something, I should do something. So swing or invest only when you truly understand the business. The patience is easy said than done. It's not easy. It is a terrible mistake to think you have to have an opinion on everything. You don't need an opinion on everything. No. Whether, again, it's a stock or a business or a sector. It's only a wise person can say that I don't understand this. This guy Charlie Munger, who is a partner of Warren Buffett. Someone asked him, what is the most important thing in stock market? So he said the most important three words in stock market are I don't know. So the wisdom to accept, the modesty to accept that yeah, you don't know this, and that's fine. You don't have to know everything and anything. Need to know only a few things which will make you successful. That's all. So what are the chances I could have identified Amazon? So you don't have see understand. You look at Rakesh Jhunjhunwala, Vijay Kedia, Radhakishan Damani, Benjamin Graham, Warren Buffett, Philip Fisher, Peter Lynch, all these super successful investors. They have lost many opportunities. Do you think they have the best 20 stocks in their portfolio? No. They have lost, I mean, not even few, they've lost like tens and hundreds of good stocks. Still, they are super rich. Isn't that a good news? That you can lose opportunities, you can make mistakes also, and you can still make money. So it is okay to lose money. It is okay to make mistakes and lose opportunities, and you can still make money. So don't run after every stock and every investment and every opportunity that you have to do this so that you can make money. No. You just need a few right decisions. That's what is important. Right? I hope this made sense. Very two small short topics on mutual funds, and then I'll go to the Q&A. So mutual funds past performance. So let me show you one table. There's a scheme which has got a NAV. NAV is like a stock price to stock. Similarly, we have NAV for mutual funds. NAV is like the price of the mutual fund scheme you are purchasing. So NAV of a scheme in year 2000 was 100 rupees. In next 20 years, it has become 2,739 rupees. This is a return of 18% compounded annual returns in 20 years, which is phenomenal. Excellent returns. Now, assuming everything else is taken care of, all the other parameters you have to look into mutual funds, everything has been taken care of. Looking at this data, will you invest in this scheme? Yes or no? Looking at this data, will you invest in this scheme which has given 18% compound annual returns in last 20 years? Tell me in the comments box, yes or no. Everything else has been taken care of. It's every other parameter is good, and the scheme has given good returns. Will you invest? Yes or no? Okay, I'm getting a few yes. I'm getting a no as well. Okay. All right. I'm getting mixed response. Most of the people are saying yes. All right. Let me give you some more data. In the first 10 years, from 2000 to 2010, this company made returns of 27% CAGR, and that is the compound annual returns. And the latest 10 years, it has given a return of 9.7% CAGR. Now, those who said yes, tell me, will you invest in this company? Yes or no? We have looked at the 20-year return, then we looked at the latest 10-year return. It's 9.7 instead of 18%. Now looking at this latest data, will you invest in this company? Now we are getting no, right? Now what I wanted to tell you here is, do not look at returns since inception for funds launched more than 10 years back. What do I mean? Let's say a scheme was launched or started 20 years back, 22 years back, 15 years back, 25 years back, and there are returns since inception, means since the company started, the scheme started functioning. Those returns are mentioned in various websites and the company fact sheet as well. Do not get influenced or impressed by that data, because in the period of more than 10 years, 12, 15, 18, 20 years, a lot of things change. The business environment change, the way fund managers work change, the fund manager of the scheme will change. Who is the fund manager? The topmost guy of the scheme, who is looking after the which stocks to buy, which to sell. So a lot of dynamics change, regulations have changed. So what was working for the scheme in the first 10 years has not worked later, maybe most likely because the fund manager has changed and he is not able to generate the returns. Yeah. So my point here is, simple point is, don't get impressed or influenced by a scheme by looking at very long-term data, though it is no doubt commendable that they have given this kind of return. But imagine someone who started investing in 2010, 12, 13, 14, 15, their returns have been suboptimal. Yeah? So just looking at the past data is not enough. I'm not saying past data is not important. All I am saying is looking at past data is not enough to invest in a scheme. Right? Now let's take a practical example. A scheme called DSP Top 100 Equity Fund. Let me show you some data of this scheme. So right hand side I'm highlighting, look at this CAGR since inception, 18.85%. Left hand side launch date is March 2003. So this is almost 20 years old, 19 and a half years old to be precise. So in last 19 and a half years, this particular scheme has given returns of 18, almost 19% compounded annually, which is amazing. Superstar performance, right? But let's go down and look at last 5 years is like a sweet spot to look at, in fact. 5 years they've given 8.39%, 10 years they've given 10.97%, far away from 19% compounded annually. So can you see the difference? So basically this scheme did very well in the initial 5, 7, 8 years, and because of which even 20-year data looks very good. But again, I'm not saying past returns is not important. All I'm saying that's not the only thing to look at, and especially don't look at very, very long-term returns, because that may not be very relevant for us who are investing today. Right? So that's one mistake, again, one mistake which people make when it comes to mutual funds. Now, second, fund manager. I just told you who is a fund manager. He's like the topmost guy of any particular mutual fund scheme, who takes the final call which stocks to buy, which to sell, and in what proportion you should buy a stock in a scheme. So he's like responsible whether the scheme does well or bad. He's the one who's responsible for that performance. Right? Now, there's something called skin in the game. Now, let me ask you a question. Let's say you go to a cafeteria, and that's one of your favorite cafeterias, and the owner of the cafeteria also sits there at the counter managing all the operations and cash and everything, payments and all. One fine day you get to know that owner of the cafeteria does not eat or drinks anything in that cafeteria. He never does that. Wouldn't that make you a little uncomfortable? You'll be like, is there some hygiene issue in the kitchen, or maybe some other issue? Why, being a owner, he never eats there? And you might stop going to that cafeteria even though it used to be a favorite. Now bring this to investments. Let's say I am the fund manager of a scheme. I am putting my day in, day out, all the time into it, and I am not investing my own savings into the scheme I am managing. That puts a question mark on my research capability, on my confidence on my own research. Yeah. Second thing, you might say, firstly, are they even allowed to invest in their own scheme? The answer is yes, they're allowed to invest. This is what is called skin in the game. When I'm investing in the schemes or stocks I'm recommending, then I have got skin in the game. If anything goes wrong in the long run, it pinches me also. I also lose my hard-earned money. So that will make me be on my toes. That will make me do even more thorough research, because I'm actually working for my own money. Right? That's why it's called skin in the game. Right? Now your next question can be, what if the fund manager is not having enough income to, maybe they've got a lot of liabilities also to pay, because of which they are not able to save and invest. Right? Fair enough. Now to answer that, let me ask you a question. What do you think is the salary, including all the bonus and perks and everything included? What do you think is the salary of fund manager in India? Tell me a range. What do you think is the salary of fund manager in India? Anyone? What do you think is the salary of fund manager in India? Take a wild guess. What do you think is their CTC on an annual? What is their complete package, including their bonus and their commissions and their performance bonus, whatever you call it? How much do you think a fund manager who is managing a mutual fund scheme in India is making as on today? Per annum, not per month. Per annum. So per annum, 10 lakhs per month, that's about 1.1 crores, 1.2 crores, around 5 lakhs, around 12 to 18 lakhs, 2 to 4 lakhs. Stocks and share market is same. There is just different names. Stock market, share market, same. एक ही बात है. 1% of expense ratio, nothing to do with expense ratio or the size of the fund. 10 lakhs, okay. So let me tell you, whatever answers I've got so far, 10 lakhs, 15 lakhs, 12 lakhs, it is very far from the actual number. It is very far. 1.6 crore plus, okay. 15 lakhs, around 3 crores per annum. All right. Okay, let me give you the answer. The typical range in which the salaries of fund managers are in India is between 2 crores to 10 crores per annum. For someone who is a new fund manager means they have some experience in the research. Now they have been appointed as a fund manager for the first time. For the first 3-4 years, they might have salary around 50 lakhs to 1 CR, but within 3-4 years, 5 years, when they gain experience, they will also cross 2 crores. So typical salary of a fund manager in India with just 3-4-5 years of experience is between 2 to 10 crores. Right? Now, do you think with this kind of salary, they can give this excuse that they don't have enough savings to invest in their own scheme? Do you think they can give this excuse? Yes or no? If someone says, a fund manager says, I'm not investing in my own scheme because I don't have enough savings, do you think that is justified? Yes, no, maybe. What is your view? Anyone? No, right? So I mean, I'm not saying they're making a lot of money. उनके पैसों पे हम नजर नहीं लगा रहे हैं. All I am saying is that they have got no excuse to say that they cannot invest. Right? That's what my point here is. I'm sure they are getting paid that much because they deserve it. No one is giving free money out there. So they deserve it, they get it, that's fine. But the point is, having skin in the game is important for me as an investor. I want my fund manager to have his skin in the game so that I feel a little more confident. Right? That's why it is important. Now check investments done by these 3 categories of people. Key managerial personnel is nothing but senior management, KMPs. Fund manager we have already talked about, and there is something called AMC, Board of Director. AMC is what? Asset Management Company, a technical name for mutual fund company. So mutual fund companies, Board of Directors, fund managers, and senior management. Check the investments done by all these 3 people put together. Now, why all these 3 people put together? Because the other 2 categories, the senior management and the Board of Directors, are the ones who recruit the fund manager. So if they have their own money into that scheme, they will not just recruit some random guy. They would want someone capable to come on that chair so that they can take care of their money also. Right? Now, you might say, where do I get to know all this information? So there is something called scheme information document, which is readily and freely available on Google and on the website of all the mutual fund companies for every scheme. As per the law by SEBI, they have to declare this information twice a year. Once is 31st March data, the second is 30th September data. For example, right now we are in September. 30th September data should come by October end or November. So right now we have data for as on 31st March 2022, what is the investment done by the fund manager in that scheme. And that information we can check in the scheme information document. Right? Let's look at 2 examples of SIDs with these 2 schemes, Sundaram Focus Fund and SBI Small Cap Fund. I have already downloaded that from the website. Look at this scheme information document for Sundaram Focus Fund, right? So there are this is like an 80-page document. There are some keywords. There's a keyword called aggregate. Just keep on pressing enter and you'll reach a table which gives this data. Look at this. The answer is nil for the scheme. The aggregate investment in a scheme under the following categories as on 31st March 2022, AMC Board of Directors, fund manager of the scheme, and key personnel is all nil. This is that cafeteria owner who does not eat anything in his own cafeteria. Right? Let's open one more. SBI Small Cap. Same thing. Aggregate. Now again, don't go and sell the scheme or buy a scheme based on that. This is one of the things to look at. There are cases when the fund manager investment is very high in a scheme, still they are losing money. So integrity and capability are 2 different things. Don't merge them up. So by having their own investment in the scheme, they are showing their integrity, which is fine. But they might not still be capable enough. So they will lose their money. They will make us lose our money. खुद का पैसा डुबाएंगे, हमारा पैसा भी डुबाएंगे. So this is one of the things to look at, very important thing to look at, but not the only thing. So don't go and invest in a scheme based on this, or don't go and sell a scheme based on this. Yeah, for selling, maybe you can do that you want to exit a scheme, but for sure, not buying. For example, look at this SBI The data is impressive. This is market value. This is what we're interested in. What is the value of the investment as of today? So 82 lakhs plus 1 lakh plus 6.86 crores. This is around what? Uh, 7.5 to 8 crore rupees in total by all these three categories of people put together. Right? So there is some skin in the game when it comes to the scheme SBI small cap. Now again, don't go and buy SBI small cap just based on this one factor. Right? But I'm just telling you how to look at this information and how to interpret that. Right? So one last thing, and then we move on to Q&A. Thankfully, there's a new law by SEBI last year itself that 20% of the salary of the fund manager and all these senior people has to go into the scheme mandatorily, and it will be locked in for 3 years so that they have skin in the game by law. So let's say a salary of someone is 5 crore rupees in the company, the fund manager or the board of directors or the senior management. Out of that 5 crores, 1 crore, which is 20% of the salary, will be invested in the units of the scheme which they are managing, and remaining 4 crores will come to their bank account the way it was coming earlier. And that 1 crore rupees will be locked in for 3 years. They cannot take out the money for 3 years. So this law is, and this is getting implemented in phases. It will take like 3-4 years to implement completely. But in my opinion, if this law is implemented the way it is meant to be, this can be transformative for Indian mutual fund industry. Because the skin in the game will be there. Only the genuine fund managers will be there, and they will put in even more hard work and research because their own money is at stake. Yep. All right. So this is what all we covered today. We covered mistakes to avoid in stock market. Higher the risk, higher the return is a myth. Warren Buffett, I showed you that video. And mutual funds, we saw the relevance of past returns and skin in the game. This is what we have covered. Thank you so much, everyone. And now I'm open to Q&A. Let me look at the comments box. Who manages the fund? The fund manager. So any individual who has got the required qualification and the experience is recruited as a fund manager. He's like an employee of the company. Let's say HDFC Mutual Fund has got 50 schemes. So every scheme has got a fund manager. So fund manager is like a designation which they have to manage the fund. All right, you can ask your questions in the chat box, in the comments box. Regarding any of the topics we've discussed today. You can also give your feedback on what you learned in the session today. Was it useful? I know it was a mandatory attendance, but whoever sat and listened carefully, did you get any value out of this? How do we find out if our investment is boring or not? Mitali, that is something you will get to know yourself. Boring in the sense, are you desire hoti hai, every day watch my portfolio, every day watch stock market, every day do something in the portfolio, buy, sell, buy, sell, buy, sell. So you are getting entertained subconsciously, right? Boring is you keep on investing in the same stocks and for very long, and it doesn't mean you don't study. It doesn't mean you don't research. You are active in research, but you're not active in buying and selling. So it comes naturally. You focus on research, your portfolio will become boring automatically. Yeah. I might have missed questions in between because a lot of chats were flowing. So you can please copy paste your question again if I've missed anything regarding any of the topics we discussed in the last 1.5 years, 1.5 hours.
Yes, a very good afternoon, sir. Sir, there is one question. What factors affects mutual fund?
Well, again, so it's not a short answer. I again do a 7 and 8 hour session to discuss every aspect of mutual fund investing. There are like 8 to 9 parameters you to look at, and it's not about just selecting something. It's also about monitoring. So there's a question in the comment box saying, "Can you tell us one stock which will do better in future?" I'm glad this question is asked. Let me tell you something. In every aspect of life, asking right questions is very important. So when you ask which stock to buy or which mutual fund scheme to buy, you are doing something wrong to yourself. You are going to make losses for yourself. Because even if someone gives you this answer, go and buy this stock or this scheme, I mean, you have to monitor it regularly. How do you get to know when to sell? You have bought something good. That's step number 1. But equally important step is to exit at right time. So you might lose money even something is good today, but it might not be good after 1 year or 2 year. You have to remain invested for long term. Does not mean you have to remain invested in the same scheme or same stock. So you should not ask this question to anyone that tell me some good 5 stocks or 5 schemes for next 5 year, 10 year. It doesn't work like that. What do you think others cannot? Why do you think others cannot ask this question and make money? If it was possible to make money like this, everyone will ask some or the other expert 5 or 10 stocks and schemes and become a millionaire. Why do we have so much poverty in India? Everyone should be millionaire by now. So it doesn't work like that, right? Yeah.
So one more question. What if I invest in companies like HCL, Reliance, ITC, and many more? What kind of returns I can expect? And after what period my investment will profit me more than my lifetime savings?
Well, see, there's no again direct answer to this. No one can guarantee or give assurance in what kind of returns you will get where. You look at the index fund. So the kind of names you've taken, this is like index companies, top 30, top 50 companies. There's something called Sensex index. There's something called Nifty 50 index. So if there's something called index fund investing, so you can invest in a mutual fund which is investing in all these 30 stocks of Sensex or all the 50 stocks of Nifty. So if you look at the returns of this index for last 20, 30, 40 years, they've given returns somewhere between 10 to 12%, 13% compounded annually. Doesn't mean they will give the same returns in the future, but what I believe, stock market in general will beat inflation. So the inflation, whatever the inflation was in the last 20, 30, 40 years, it has been beaten by the index. Future inflation is expected to be less in India. So returns will also be less, but they will beat inflation. But you can't really, and coming to the next question, that how long, as I said, 5 years is the minimum you should have in terms of your goals, planning and all. Less than 5 years is a gamble in my point of view. There's a question how to recover losses. When you say how to recover losses, see, I told you in one of the slides, out of 10 stocks you will make losses in minimum 2, no matter how much research you do, right? And if you're investing in a well-researched portfolio for 5 years plus, you're bound to make money. That's what my experience is. So there's no question of losses. It's about how much money you can make. Losses will be there in interim. If you cannot bear losses in the stock market, if you cannot bear the volatility or fluctuation in the stock market, you should not get into stock market. अपनी नींद खराब करके पैसे कमाने से कोई फायदा नहीं है. First, train yourself, read books, learn, do research. Once you have the right temperament, and then of course with experience also you gain temperament, but you should have the basic knowledge and understanding and temperament, then get into stock market. Don't expect some quick money. It is not. So stock market is the easiest way to get rich. It is not the quickest way to get rich. If you want to make quick money, maybe go to casino and try your luck. Stock market is the easiest way to make money. It is not the quickest way to make money.
So one more question. Which book you will prefer for stock market?
Again, so I don't have a count of how many books I have read. You can just again go on Google, type best books on stock market. You'll get some 200 answers. Pick any, because when you're reading the first book on stock market, your learning curve will be very sharp. So there's no hierarchy that read this book first and that book first and that book third. Just start reading and make sure you read every day. Your entire lifetime will not be enough to read all the books, but just keep on reading as much as you can. But there's no answer to that this book is the best or something like that. You just read whichever cover you like the best, just go and read. Doesn't matter. What's important is that you should read. That's what is important. Let me read a few questions.
The book name is What About Rich Dad, Poor Dad?
Yeah, that's a good book. But that's not on stock market specifically. That's more on how do you think about money, and that's a very good book. Another book in the same league is Psychology of Money by Morgan Housel. Even that is a very good book. So you can maybe start with these 2 books to create that context and that right temperament, and then get on to the hardcore stock market books. What should be my first step? I have to research on stocks. So what should be your first step? The first step is you can do 2 steps at a time. One is start reading the books. As I said, start reading the stock market books. And I'm talking about fundamental analysis. I'm not talking about trading and future and options and technical analysis. That's a pure gamble in my view, at least. Start reading books on fundamental analysis. And at the same time, start reading articles and reports. Don't worry about understanding every line and every word. You will not. Even I don't understand everything. what's important again is to get into that zone, get into that comfort zone of reading and understanding reports. Eventually, gradually, you will start understanding.
Sir, there is one question. Can you please share any experience where you got much more returns from where or from your expectations in any stock?
All right, so let me tell you how do I approach investing. Again, I share this in great detail and in my programs. Stock market research is about rejecting stocks, not selecting stocks. What do I mean by that? I don't look at a company and say I want to make a lot of money from that. Let me invest in that. No, I look for reasons. Look for negative reasons in a company. I look for reasons to reject a company. So out of 200 companies, when I've rejected 199 companies, and that one company I'm not able to reject based on the set of parameters I've got, then that is the company I want to invest. So basically, the idea is to cover your downside, to protect your downside. It should not go much down. That's what my aim is. It doesn't mean it will not fluctuate. You saw the example of Supreme Industry, the way it fluctuates. It will still fluctuate in the short run. In the long term, the chances that it will go down is very less, not zero, but very less. So the idea should be you look for a company which has got a clean management. You look for a company which has got a good growth potential, and there are no negatives as per your parameters. And then in that case, since the company is not expected to go down much, the only way it can go is up. So there have been. I mean, I would not. So the example I took was Supreme Industry. I when I invested in 2009, I was not expecting to make 100 times in this company. So that could be one example of, you know, maybe making more than what I expected. But I don't really expect that I will make 10 times or 20 times or 100 times in any company. I just invest based on the analysis and I take a call accordingly.
Sir, one more. Investing in mutual fund or SIP. Um yeah, invest in mutual
Or
or
yeah, I
SIP.
got
Yeah.
that question.
Okay.
Yeah, and do own research and invest in stock market, which is better. See, even if you're investing in mutual fund, you need to do research, because the way you have thousands of stocks, you have hundreds of mutual fund schemes. So you can't just pick any scheme and make money. You look at the history of 10-year history of mutual 5 or 10-year history of mutual fund returns. Most of the schemes have given negative returns, or they have got substandard returns. Substandard means less than FD returns. So even you have to do this much more research in stocks for sure, but you have to do research in mutual fund also. So either way, you have to put in your time. Now depends on you how much time, energy, and passion and interest you have got to research. If you have got, that passion to learn and read, stocks is what you can go for. Else, mutual fund also requires your time and energy, but it is considerably less. Should we invest in US stocks? I stay away from US or any other market, because in my view, the kind of growth we have got in Indian market, it's not available anywhere. It's all fashion and fad, which is there. US market. Everyone last 2-3 years was doing US market, US market. Last 6 months, it has gone down. Now everyone is like, oh, India is better. I have never invested in any market outside India, and I don't think so. I will do so unless and until I see growth potential more than in that country compared to my country. I don't see that. The entire world is coming and investing in India, but our Indians have this charm for foreign things, be it buying something or be it investing, and we end up doing that.
So one more. What are US stock futures?
Future and options is again, it's like a ultimate level of gamble in my view. So I can't really explain in like few lines. You have to read on Google, maybe just find out what is future and options, whether it is US market or Indian market. Every market has got something called futures and options. So that's what it is. I believe you're asking for that futures technical word. If you're asking from perspective of what is the future of US market, I mean, what do you think is the future of economy of that country? Because stock market of any country is a representation of its economy. Why has the stock market in India gone up in last 40 years? Because the economy was going up, right? Why will it go in the future? Why it is expected to go up in the future? Because the economy is expected to do well, right? So any country's stock market will do well if the economy does well, because ultimately you're investing in the businesses which are doing business in that country. So if the economy is doing well, the business will do well and the stock price will do well. Yes, we need to diversify your stock, but that does not mean you have to diversify through US. Again, I'm saying it's a fad, it's a fashion going on just for the sake of diversification. People are investing in US market, but do you realize that? I mean, the level of understanding we have of any other market. Forget about any other market. We don't even know about our own country. You invest in dollars also when you invest in US market. And do you know the correlation between US market and Indian market is 0.7? Which means 70% of the time when the market in there is going up, our market is going up. 70% of the time when the market is there is going down, our market is going down. So where the hell is diversification? वो एक बहाना चाहिए लोगों को इन्वेस्ट करने का, तो बहाना मिल गया, कह रहे हैं डाइवर्सिफिकेशन कर रहे हैं हम तो. हाउ आर यू डूइंग डाइवर्सिफिकेशन व्हेन द कोरिलेशन इज 0.7? Diversification actually means when your US market is going down, your Indian market is going up. That's what the benefit of diversification is. Or when your US market is going up, when your Indian market is going down, US market is going up. That's the benefit of diversification. But that's not happening. I stay away from cryptos because I don't understand crypto market. So I stay away from anything which I don't understand. For me, it's like Greek. I don't understand, so I don't invest. You can visit my website for any programs or courses you're looking for, though I would not talk much about it in this class. You can go on my website later on and figure it out, and you can write to us. Contact details are given there. If I invest in US market, do I pay tax in the US or India? You pay tax in US, I believe, though I have not discovered this in detail. But yes, if you're making capital gains there, you have to pay some tax there. Any other questions?
No, sir.
All right.
I think we are done with the question and answer session.
Sure.
Good afternoon, everyone. As all good things come to an end, so is this webinar. I, Ms. Deepika Arora, BAF faculty on behalf of Patkar-Varde College, would like to take this opportunity to propose the vote of thanks to those who have directly and indirectly contributed to this RUSA-sponsored national level webinar on investment avenues for millennials, organized by the Department of BMS, BAF, and BBI. At the outset, I would like to propose hearty vote of thanks to our speaker, Mr. Anupam Rumta, for making excellent presentation and making this webinar interesting and meaningful. We are really enlightened with your knowledge and presence, sir. Sir, the way you provided your valuable advice on how and when to start investing, schemes available for investment in the market, mistakes to avoid while investing, reading books on stock market. Now, I take the opportunity to thank Sri Kishore Ranganekar, President of Chikitsak Samuha, Rajesh Desai, Vice President of Chikitsak Samuha, Dr. G.V. Pandit, Joint Secretary of Chikitsak Samuha, Dr. Mala Kharkar Ma'am, CEO, Dr. Teresa Joseph, In Charge Principal of our college, Ms. Ruchita Dalvi, Chief Coordinator of Self-Financing Section for us, providing an opportunity for conducting this webinar. I would also like to thank BMS and BBI Coordinator, Ms. Swati Thakkar Ma'am, and BAF Coordinator, Ms. Jyoti Langkote Ma'am, for their contributions and guidance. A special thanks to all the organizing committee for their support and coordination. A heartfelt thanks to all the participants for such an interactive and such an Q&A session was very useful for the students and all the participants. Now, I request to all the participants to submit their feedback in the link which is provided in the chat box so that we are able to generate the participation certificate. Thank you so much, sir. Thank you all.
Thank you so much. Thank you for inviting me, and thank you everyone for participating and asking questions and being active. Thank you so much.
Thank you, sir. Thank you.
Thank you. Bye-bye.
Bye, sir.